Hello, this is Danny Holder with Capital Retirement Planning, and I wanted to provide a market update of what the market is doing currently and where it's been in recent months and even recent years. What we're looking at is a point and figure chart of the S&P 500. So we're seeing what the S&P 500 is doing currently and actually going back to the 2006 time frame. You'll notice the vertical lines on here are showing the beginning of new years, and so from this vertical line, for example, to this one is 2011 on the chart. This is 2012 and currently in 2013. The way this chart is read is by looking at the last column, and we are currently in a column of X's. X's denote times that the market is going up, while O's denotes times that the market is going down. So you can see we're in a column of X's. You'll see numbers in here as well, and those numbers refer to months of the year. So this area being 2013, the one here would signify January, February, March, April, May, etc. So currently the market is at a high of 1626, and if we look back in time, going back to 2007, we'll see that the market is just now in recent weeks exceeding where it was in 2006. So there's a couple of ways of looking at this situation. First of all, we are at a new all-time high. Market has never been this high previously, and that means we're somewhat in uncharted territory. There's unlimited room for it to continue going up, but as you'll see from the charts, the market goes up and then it pulls back repeatedly. Sometimes it goes down more than it goes up, but as you can see, going back to 2009, the market has been basically in an uptrend except for 3 or 4 pullbacks. The two perspectives I was mentioning that you could look at is that those who rode the market down beginning in 2007 and then rode it back up are now back where they were. And so many people are feeling very good that the market has recovered. They've gotten back to where they were in 2007. So that's one way of looking at this. The other way of looking at this is that since 2007 there's been zero gain. That we're just now getting ahead of where we were. So riding the market down can certainly have consequences. If we look at where the market was in October of 2007 and then go down the chart to its bottom at 2009, this was a 57% drop in the market from 2007 till 2009. Many people experienced those types of losses in their portfolio, and to get back to even requires 100% gain. So we've seen 100% gain in the market since 2009. A relatively short recovery as compared to previous recoveries, which have taken as long as, in one case, 25 years, and in another case, 17 years for the market to reach the point at which it had risen to previously. So this is a pretty short time period actually compared to previous situations. So that's a look at the S&P 500. I'm going to pull up another chart now. The chart we're looking at now is known as the bullish percent chart for the New York Stock Exchange. This chart, rather than showing price as the S&P 500 chart showed, this chart is showing percentages. There are some 2,000 stocks on the New York Stock Exchange, and if we were to look at the percentage of stocks that are on a buy signal versus the stocks that are on sell signals, that is exactly what this chart is showing. And currently we are in a column of O's. We always read the last column to know where we are. In April, the market saw 6% of the stocks on the New York Stock Exchange go from being on a sell signal to a buy signal. There was a 6% drop in the percentage of stocks. It had gotten up to about 76%, perhaps a little bit above, but then there was a 6% drop. And that was a very quick, very short drop in the market. It quickly turned around and started going back up. But for us to begin recording a new column of X's, it would have to go up by 6% from the low that it reached before. So currently it's at 73.57, which on the chart is about this area right here. So very close to reversing back up again. Now what this means is that when this chart is in a column of X's, it's an indication that the market is on offense. In other words, the market is heading upwards, and this is a time that hopefully we can work to make money in the market, as opposed to it being in a column of O's, which typically means the market is trying to take money away from us. So the market is either on offense or it's on defense. So we have a little bit of a mixed signal is the bottom line, and that mixed signal is that the market had turned down quickly in April, enough to register a column of O's, but it quickly bounced up and is very close now to being back in a column of X's. And two things to take note of here. When it goes above the 70% level, that is generally a level of higher risk. And so we're right at that point of the market being in an area of high risk, which simply means that at this point in time we don't want to turn the lights out and leave the market, but we want to be very cautious. We want to have our stop losses in place to know what type of loss we're going to accept should the market start going down. So we have to have a plan for when the market goes up, and we have to have a plan for when the market goes down. So those plans are in place. I would say that at this point in time we need to be cautious, and we need to be ready to perhaps take defensive action should the market start heading down. That concludes this week's market update, and I'll look to talk to you again soon. Thank you.